Let's see. Okay, looks like we're live. I gotta send out this link. Pump the links. Everyone just if you're subscribed, just go ahead and share that link. I'm gonna do the same. Just give me a minute. Let me play something for you to listen to. So today, pretty much what I'm just gonna touch on is just some of the topics that Richard had addressed on his marathon 8-hour live stream. I think there's a really important, this is a really important time in the hex history, where something that's happening on another blockchain is interfering with the game theory of hex, and it's creating these dynamics where it appears like that there's going to be a fork with Pulse, and it's going to be a really interesting event because of everything that's at stake. Like if you think about how Bitcoin Cash and Bitcoin, when they forked, for almost similar reasons, that was a multi-billion-dollar decision. The choice between Pulse and Hex, that's on Pulse. So the non-ERC20 Hex, that's going to be a multi-billion-dollar decision as well. Because if so long as there are bridges, and that was a question that I really wish I would have followed up with more with what I had asked Richard in his live stream. I asked about like what the risks are with not having access to the other chains, and so just how liquid it will be to go from Hex to Hex Pulse, and what that market's going to look like, because that's a really important decision to make, and maybe that's where kind of like that ultra high echelon of people's ROI from Hex will be how they play the Hex versus Hex Pulse. Like you could go from a shrimp to a whale, perhaps. Maybe if you play the staking of this right, might be the case. And so there's a lot of important decisions to make, and it really touches on a lot of the things that we've talked about here about like minimum viable stake. We've talked about, just like the impact of, other, competing like yield producing products, and, just kind of how the market measures that risk. And so there's like all these things are at play here. And I definitely want to touch on some of the other things that Richard said in his stream as well. Because there really was a lot said. And when I asked on Twitter what people wanted to see, people definitely said the kind of reflections on what was announced in Richard's stream. It was a long listen. I still haven't even finished it yet. I've listened to a couple parts, kind of back and forth, and it's this is a really important moment in Hex, so it's pretty excited. Let's see who's in the chat. Oh, hey, what's up, Degron? Welcome. Here, let me share this link before we get started. One moment. I'm just gonna play this while I'm doing this. So just go ahead and listen, and when I'm ready, I'll
so dumb. Working on it. Oh, I'm in the wrong account. It all makes sense now. Creator Studio. Sorry for this being so clunky, guys, but there's not really a way to make this work too much better, sadly. grab my title. All right, now where's the link? Got it. I'm sharing the link and we're off to the races. And Twitter. Should have put pulse in the headline. Oh well. All right, we're retreated everywhere. It should be good to go. Should be good.
All right, I'm ready to go. Yeah, so pretty much, just high level what's going on. A recent change on the Ethereum network is pricing out a lot of the smaller hex stakes that are coming out, where the cost of stake is greater than the value of the hex, and sometimes by a lot, especially with like these really small stakes. So what's happening is a lot of people that are really excited about hex and really into it are, they're getting priced out. They can't end the they can't end the stream, or they can't. Sorry, I'm having streaming issues. They can't end their stake because it's just not worth the ETH that it costs. So those people are kind of in a tough situation, and so a solution is to port something of hex over to a new chain, and just to try to we're just try to kind of port the system state over, which is a concept that has definitely been like if you listen back to the streams when Richard was building it, that was kind of the idea where it could start on Ethereum and then port to a new chain, and so that's always been a possibility. Like this isn't necessarily like a new concept, and so the what it sounds like from the stream that Richard had the other night was that the only thing, or something for certain, was that all the hex system state would be ported over to hex-pulse, and that was like the only kind of promise. It's funny because an older narrative of hex is really about not being about promised things, but like with this development, it is it's not there today, so someone's got to build it, and it's really good that it's Richard in public building it, because who else has more rapport, and so that's like a strong, it's really showing that social consensus, that is a really important part of how these cryptocurrencies can aid in an economy, because there's in hex there's definitely and with everything, you see it in Doge, you see it in all types of crypto. There is a layer of social consensus, and that's a really important thing for just for society to just kind of use the financial tools to get along. Like good healthy social consensus is good, and I think the way it's playing out in hex is pretty good. I also want to try to set people's expectations with what just like how, for your current hex stakes that are, you're priced out of, like you can't afford the ETH to end it, or like just, it'll cost you, $100 of ETH to unlock, say, $20 of hex. There's a lot of people out there with like these like tiny little stakes, or just over time, they have, say, 100 stakes ending in the next couple months. A lot of those just like, that money's not going to support the hex price. I mean, in a way it is, but like that money's, it's being paid to Ethereum miners. And so, like a lot of the value is on that like tail end of the, relative size. It is creating a price floor, and it's good in the sense that that helps support the general price and makes hex more resilient, because like so long as that interest that the stakes are earning is worth something, so long as there's a market for that, that's a really powerful just like forward force that is part of what makes like a broader like crypto financial ecosystem. And so like having price floors is actually a really healthy thing. And that's part of why, Bitcoin has had so much success in the like reserve asset area, is because there was a price floor set when the Bitcoin Cash and the Bitcoin fork happened. It was all about the price floor. And so the Bitcoin Cash strategy was to lower the price floor so that could, more people in aggregate. But in Bitcoin, what lived on was like the narrative about scarcity, and that applies in the supply, and it applies in the just like the block space, and like the price floor was like an important thing, like where that was like a measure of success of how good that blockchain was, is how much are people willing to pay to use it. And that's really what Ethereum fees mean, is that it's worth using. Someone's using it, and so it's there's importance of having these price floors, and so that's what this kind of may turn into, where maybe they're just going to be different use cases for like the hex, which is kind of like the like reserve hex, and then the hex-pulse, which can be like the daily transactional, potentially smart contracts kind of interact over there, and all these things that can support the financialization of hex. I think that's really how this is going to play out. So what it really introduces are 3 different assets that you have to balance the risk of holding. Four. So ETH and hex on ERC20, because you're going to have your hex stakes, and so to perform those, you're going to be having to pay Ethereum for it. And sometimes just making the gas so much is that the unit gas cost is increasing, but the price of the gas is also increasing as well. So like what we had talked about last time about this, like that's what like that's like a big driver, and that's seasonal. Sometimes it goes down, and but like this like broad like the multiple went up. So like there's kind of 2 things there, and so just like they're so having 2 different like kind of like fee structures for a hex monetary policy, it could create a really powerful ecosystem where like for kind of like the day-to-day use of the of like your hex, you're doing that on the hex-pulse. And maybe we'll see a lot more extensive like pooling of hex, and like the encapsulated stakes, so being able to just kind of like just financialize the hex stakes. And I think that's going to be a really important development in the hex economy, kind of how in the Bitcoin economy, getting Coinbase going public and having all of, really good exchanges. Like really almost no one has issues getting, like that's really where, I do have respect for like, the Coinbases and the Krakens of the world, and others. That's not all, but they really made it seamless to, for Americans to get into crypto. Like, you can get your money in there. And so, those played a really important part in the financialization of Bitcoin, and that's why Bitcoin's now it's like a $1 trillion asset. And so like for Hex to become $1 trillion asset, the financialization of it is really important. And I think that like hopefully that's what becomes of the fork, is that this fork is a tool in financializing the ERC20 hex. But what we don't want to see is, we don't want to see it be where the, kind of like how Bitcoin Cash like didn't really aid in the financialization of Bitcoin. Maybe it aided in like the merchant adoption of like crypto in general, which is good. That they did their part. But like as far as like what takes it to be $1 trillion and quadrillion dollar asset is the financialization. And so, I think that's really what I'm looking for in the hex and the pulse. And there's going to be a lot of decisions to make. Like this is going to be tough because you have to balance your hex and your ETH so you can like finance your stakes on on ERC20. But then like you also have this other one that like it's almost like it's like fresh ground. People always want like another first chance, and so that could like cause like a big momentum swing, is if just like there's just like big like if for some reason like the hex-pulse like unlocks this whole source of demand, and that's just going to be how they onboard, and so it's gonna that'll be the thing to see. And it's going to be a because when you're holding hex-pulse, you're also going to have to hold the pulse coin, like because like the hex-pulse, from what the stream made it sound like, is just that like the hex-pulse is going to just be running, and it just how like hex runs on Ethereum as an ERC20. There's going to be like hex-pulse, which is just going to run like maybe PRC20. And then there's going to be like the pulse coin, which is like equivalent to what Ethereum is. It's equivalent to what BNB is on Binance Smart Chain. And so there's really two new coins, and we have and then we still have the hex and the ERC20 hex, which isn't going away. Like that's the power. Like what are the max length stakers going to nuke their stakes to shift over into you couldn't nuke them there, like you couldn't nuke them to like transfer those over to Pulse, unless maybe that's how they designed Pulse. But if the hex Pulse contract is the same as the hex contract, what it really is it's it's just like the inflation, like if it just like continues to operate like in perfect sequence together, in total that system will be inflating at the constant 3.69%. So it like on a single day it would like the daily inflation would increase by a lot. But if it is truly applied to everybody, it's just as if it happened to nobody. And so like in that moment, there's going to be two of these things that are they're like the same, but and there's going to be like a liquid portion that potentially, like if there is a bridge, like could be like that's where the market will be set. Like the market will now be set across the Pulse hex and the Ethereum hex, like that, like over those bridges. Which in a minute here, I'm going to play the video from when I asked Richard on the stream about like the bridges. So like the market's going to be set between the hex and the Pulse that's liquid, because if like there's the staked hex, like that's not moving, and if there's that equals you staked Pulse, like that's also not moving. And so like you have all of your current staked hex, so like you can guarantee those won't shift. People won't sway demand that way, with those coins. But as they come unstaked, like that's kind of how the market's going to measure what that's going to be worth, and that could swing drastically. And what people may have thought were going to be fortunes made on hex, may end in loss, because you have to balance the hex. You have to balance the Ethereum to pay the transactions to do the staking on the hex. You have to, and the swapping and, the selling and the buying. And you have to now, manage the hex pulse version and whatever amount of pulse that you're going to need to invest in, through that, and then you're gonna have to have a bridge, because if you're relying on new fiat coming in, you're gonna need that on ramp. And so long as there's a good bridge where you buy Ethereum on Coinbase, you can transfer the Ethereum, to your MetaMask wallet, and then in a single tap trustlessly you can bridge, and you have the other one. So long as there's sufficient market there, there's going to be a fraction of the value that is suited for a different purpose than the long-term hoard, because it's reducing the per transaction fee, and so that's really where you this even further amplifies the value of the long-term stake. It's because they have 5 years to make up for the increased, time of the, because every day that goes on, it costs a little bit more in gas. The max length stake, those extra 5 years earning at that increased share rate, that can really make up for the, just that difference. So, sorry, let me make sure my internet connection's working. Okay. Sorry, it's saying it's. Yeah, so here, let's just play the question I asked Richard, and then, we'll talk about that. So here we go.
Just a quick question. So we all know kind of the benefits of moving to another chain that's not as congested and does. Quick question.
That's funny. I was right on it.
Well, I guess Tanto does. Well, I guess Tanto doesn't have his mic working.
Oh, hey.
Oh, hey there. What's up?
Hey, thanks for doing this. Just a quick question. So we all know kind of the benefits of moving to another chain that's not as congested and doesn't increase the gas costs. But what do you think are the risks? We're saving on fees, but do you think we're going to be paying that in some other way?
I think that in the beginning, you would think, oh my God, only proof of work works. That's the only thing that we know works, and everything else sucks. Because you have this parade of imaginary horribles that people try and sell you. This parade of bullshit. And then you measure the world, and you go, okay, how many successful forks of Ethereum are there? Shitloads. How many are having problems? One. Which one? The one that uses proof of work. So Ethereum Classic uses proof of work, and they get 51% attacked all the time and fucked up all the time. TRX is a fork of Ethereum. Are they getting 51% attacked? No. Anyone losing money? Their TRX transactions getting rolled back? No. Works fine. What about XDAI? What about Matic? What about Boro? What about all these other forks of Ethereum? They work fine. Nobody's losing, their transactions aren't getting rolled back, and they all use proof of stake, except for TRX. It uses proof of work. So proof of stake works fine. The only people that are having problems are proof of work people. And so as long as, oh, by the way, BSC is also a fork of Ethereum.
So what he's talking about here, is that there's not, by moving to a new chain that's forking from Ethereum, you're kind of just building upon all of the work that's been done on Ethereum to date, which is good, which it obviously can support, multi-trillion dollar, multi-$100 billion markets. And so, forking is a good start. And of the forks that have happened, there's really not a history of major problems, because typically what these types of proof of stake, what these chains are, is a it is the like that incentive is, it's like a main driver in the business cycle. And so, one sec, hold on, I'm saying, this keeps freezing up. Sorry about that. It says it's not having a good connection. Okay. Yeah, so what he's saying is that people just don't really have those problems because, these forks that are proof of stake, they kind of do require an extra layer of centralization. And so, that's kind of generally why, because like the proof of work, like because other networks like can just like attack it. Sometimes the incentive is there to do it. It's like worth it. But with proof of stake, you give up some of that like centralization, but it is an example that like you don't really see issues because of that in coins, maybe over time like that changes, but he's right that there really haven't been like major issues. Like you're more likely to lose your money on a bad trade than you are through like failure in the consensus or like double spend or whatever may happen with proof of stake. Like, you're way more likely to just lose money on bad investments. So, if that's like the threshold, then, these types of forks can work.
I haven't heard anyone losing. I mean, everyone's getting rug pulled over there because it's a new scammy ecosystem, but like, there's no problem with validators. There's no problem with nodes falling over. There's actually they do have problems with the reporting. Like, they have a Uniswap fork there, but it's uniswap.info fork doesn't work. It's kind of broken right now. But it's a new ecosystem, so you kind of expect some of those things, I guess, with higher throughput, because you were forking from something that had lower throughput. So the stuff that you forked wasn't meant to deal with 3-second blocks instead of 13-second blocks. So, the only fear that you could have is that some evil validators own all of the stake and are okay to throw all their money in the garbage and burn the value of all their stake in order to validate improperly and get slashed and lose all of their money. It just doesn't make sense. This is the same idea of like people are afraid of centralized ownership because people that own things could nuke the price. But you don't have any record of anyone doing that. So it's like, Elon Musk could go nuke the price of Tesla because he owns 30% of the shares. Why the fuck would he do that? Doesn't make any sense. Who cares more about Tesla's price than he? Nobody. And so as long as we have a track record of humans acting in their own best interests economically, shareholders that own large percentages of companies don't tend to nuke their holdings for giggles and destroy themselves just to harm somebody less. They harm themselves more to help harm someone else less. That shit never happens. And so you also don't see that in the node infrastructure.
So that he's talking about like the risk of centralization, and that's always been the big, like FUD in Hex that people have is that, everyone's like, oh, the OA is just going to nuke the price. And, that's, but the thing is like, those are his coins to sell, and so he can absolutely sell like, there's nothing stopping that. But the thing that is really like a layer of social consensus, like part of what, enables, part of what like enables the value of Hex is, I think that like kind of like like people are kind of out in public, like people's like real faces on there. Like there's no like anonymous dev that's like behind the scenes doing stuff. And I think that's like a serious like social value, to the, like the Hexkins, that's kind of compounded with the power of that stake where like you can't just hop out. Like, people hopping into Dogecoin today, they could just get out tomorrow and be done with it. But like people that are kind of invested in this type of, like kind of like cultural value of like delayed gratification and like, savings products, because that's really what Hex is. It's like a high yield savings product. And so, when that's like the type of thing you're cultivating, like, the social consensus is huge. And I think that's like, from any massive whale's perspective, like if they can gain, influence and wealth, by hoarding and showing that they're hoarding. Everyone hates on Elon Musk and Jeff Bezos because they think that they hoard all the wealth, when really you want them, you want to be in assets where you benefit from the big person hoarding, because then you grow with them, they're providing price support, and I think that's a really good way to align with these. And that's just kind of what the hex that runs on Ethereum, there really is strong social consensus layer to it. And, so it's, when the community is going to be kind of faced with this decision of, okay, where does, with my liquid hex or with new money that I could invest, do I choose hex-pulse or do I choose hex on Ethereum? And so, I think it's really going to, it's going to be up to the big holders of, of the liquid hex. And, that's really where the market's going to be set. And, and so I think Richard, if he, if I think someone published, I saw a link to a spreadsheet. It was an OA audit. If people are, really monitoring that holding, and that's good. I think that's really going to sway a lot. Does OA hex bridge over to OA, OA hex pulse, or maybe does the OA somehow become the that layer between the two, where that's the market. So it would be a really liquid market. Which, if you want the prices to not move, you want a really liquid market. If you want the price to only go up, you want an illiquid market. So maybe what that ends up looking like is you have the Ethereum and the hex, and then the bridge between hex and hex pulse. And what you do is, you have all the major holders of liquid hex are providing liquidity, and so you keep that. So when you have more liquidity, through a bonding curve price like Uniswap, you squeeze the volatility, and so maybe that's what it kind of becomes, is that the on ramping can come from either way, and ideally they kind of match each other. And so then what that would converge to is that hex and hex pulse are generally one-to-one interchangeable, because there's so much liquidity in those markets. Maybe it seasonally adjusts or with different supply shocks, but if there's a lot of liquidity there, if that's what people kind of use their liquid hex for, is providing that liquidity, maybe that's a way to approach both of them, where it kind of becomes one. Because still, after that day, on that, if, this is another thing we're going to talk about, is just how long. I definitely want to set expectations of what this might be like. But on the day that there's a fork and there's hex and there's hex pulse, it's it's like another big payday. But then everything, but it's applied equally to everyone. And so it's just from then on, it still carries on at 3.69 inflation from both of them, and so they really can, have a version that's operating on this other chain, which means it's in another market. It can, operate in and continue where the monetary policy actually remained the same, because that's it doesn't necessarily matter what the blockchain is that executes the hex contract. But for hex as a form of money, and hex as a social consensus around monetary policy, because hex really is just kind of an idea, it's really a, it's expressed in a smart contract, that is, about the stake, and where your longer pays better, but that doesn't have anything to do with it must run on the Ethereum blockchain. And so hex, and especially as the brand of hex that is kind of held together by Richard, that's that layer of social consensus is really strong. And I think that where other things have forks have kind of failed, I think that like, something that may enable the hex-pulse fork to be like something that's like it strongly complements and amplifies the value of the hex stakes that are on Ethereum on these very liquid markets that we can sell into. It's like we want to onboard through our ecosystem and sell into the Ethereum ecosystem. And so like if the hex-pulse can really be a strong onboarding tool into like Hex, where like the hex-pulse can be just like, because it's all growing at the 3.69% together, and so smaller stakes that aren't feasible on ERC20 are on that network, and by staking on one network, you're bearing the cost of not having staked on the other network. But if you're priced out, you're priced out. So like you only have one choice. So there's still going to be a price floor for that one, but provided there's enough liquidity, and if like that's what the market demands, is like kind of like a lightweight version of Hex that maybe you do like shorter term or like smaller staking strategies on, and the cost you're paying is that you're not holding that like you didn't somehow get that over into Hex and like what you could be making on that side. Like and maybe that's just kind of how it's going to play out, where the Hex on the ERC20 is just going to converge to the max length stake only, where like maybe it's only feasible to make a something that could happen is like, what if this is like a doomsday scenario? What if some other parameter gets changed between now and end of 15-year stake that could just like make the 15-year stake infeasible to end or impossible to end? What if it starts squeezing there, and like that ends up being paid like all to like maybe there's like a gap between like a 10-year stake and like a 14-year stake or something, that's like a sweet spot where you had enough where the hex that you were unlocking was was more valuable than the ETH to unlock it, and you could afford the ETH, like you had the ETH on hand. Like maybe there's in the future there may be like another squeeze on the supply that really drives the price up, and in that setting we may see like just like the maximum, like the best window to stake could converge around something that's not the max length. And so there's a lot of unknowns kind of going forward with like these big changes to the to the like just the impact of transaction fees on the Hex contract. And so moving over to a new chain, there's a lot of ways it can go, and part of it is like software execution, part of it is like just social consensus, but from what the Hexagon community, like there is pretty strong social consensus, and there's people are producing products that are working really well, like the Staker app and all the tools built by those guys. And so, there is a lot of people with like a vested interest in the success of Hex as the idea, and as the smart contract, and as like the social contract. And it's there's definitely going to be big opportunities around just like as that plays out, and so as far as like when I think this is going to play out, I think that it's going to be I say more than a year, and that's a good thing. I think that the issue with the infeasible gas to end the stake, I think that really might get resolved by Ethereum sometime in the next, say 4 years, and if that happens and it's done in a way that like, which it should, like I at this moment, I don't see why it wouldn't. But if, somehow the gas issues are solved in a different way, and, massive gas consumers move off chain and, just, to like layer twos, the issue kind of resolves itself, and then maybe there won't be as much demand for like the hex pulse that's on a chain that's even though there may be bridges, is just separate from like where the the hex that's on the ERC20 economy, which has other benefits outside of hex. And so, there's definitely going to be price discovery, and it really it's really a matter of like what the big pools of the liquid hex demand. If you're the person with the most liquid hex, you have the choice. Which one are you going to demand? Nobody can tell you what to do. Not your keys, not your coin, and so. That's probably what it's going to be. And so the people that, switch, the major large holders, switch, and then just it catapults into everyone doing there's going to be massive, gains to be had by just kind of being on the right side of that prediction. So, if the adoption amplifier was a, kind of like community pricing experience, that was pretty speculative, kind of 351 straight days of a pure auction. There's a lot of interesting game theory there. There's a lot with the staking through big payday, and those two things really powered forward hex and enabled it to be a serious financial product. And so maybe that's a new discovery that we've made with hex, is that you can kind of spur along these developments to support the financialization of an asset by these kind of like a deadline based type of speculative experience, the adoption amplifier, 351 days of auction, and then and then on that last day, kind of simultaneously, there was this whole staking before big payday strategy, where they're leading up to a point in time, and that introduces a lot of volatility and a lot of opportunity. And then now, with this whole layer of hex, hex stakes becoming infeasible to end stake, with that happening, and it's really going to push the price of the hex up, and now there's potentially a new coin on the horizon that you're going to have to measure your hex against that you do have, or measure your new money coming in, or measure what you think is going to be demanded. If the hex-pulse launches, that's a whole other decision, and that's kind of going to be I think that's going to introduce a whole new level of volatility, and in a new opportunity for people to kind of move up that share ranking on the hex ERC20. You can move up that ranking by trading the hex-pulse, hex ERC20 liquid market right, and then staking on the right one, where by understanding this minimum viable stake, and planning your stakes around that, you can you can guarantee that your stake isn't too small to allow the incremental gas cost to eat into your ROI by you need to keep that in a suitable range. That's your choice, how much you're willing to pay in fee. And so planning your stakes around that, where you're holding a lot of liquid hex, accumulating the liquid hex to get to the level of number of hex and then days of hex where it's optimal for staking. That's going to be a really lucrative financial position to be in. And so I think that this is a new tool for that. And I think there's going to be some really, really exciting opportunities here, and I really hope it unfolds. You shouldn't have any expectations from the work of others. If you're not employing anybody to work on anything for you, you have no right to tell them how fast to do something or how many times to iterate or think about something. If you're not building it, you really shouldn't even have any expectations that they'll even ever finish. If they're, if you're not paying them, they're not part of your employment, you really can't have that expectation of anybody. So not only you should have expectation of profit from the work of others, you really shouldn't have any expectation that they'll do something in your specific interest. And so, that's really the, you really shouldn't have that expectation, because, and also because, the people that are writing the code, they're going to write the code that they want and the code that's like feasible for them to execute. They're going to write that code. They're not going to necessarily write the code that you as an individual on Twitter or on Telegram want. And so, there's, if you're, just kind of watching from the sidelines, it's best to just like not have expectations, because, software is so hard to build, and especially financial software. Like, this is uncharted territory. Like, when Hex launched, like, there was like a whole like bull and bust cycle of previous learnings, of how to launch a token. Like, when Hex launched there, that was late 2019. There was 2016, 17. I mean, really since before then, there was like, a full multi-year market cycle of like new economics, like new monetary policy, and then like the whole like bear market where things failed and vulnerabilities were exposed. And so Hex was able to benefit by launching as an ERC20 kind of after that first like boom and bust cycle. And so that's I think going to be a challenge of trying to launch a new chain, is that that's like a longer life cycle than these like, fly-by-night ICOs that launch tokens with like all these different parameters, and some died, some lived, some outperformed everything. And, they all did something different. And so like there's like, a lot of proof to look at from that to like design a new thing. There's just not the same level of stuff on these chains, like, because like there's just less of them, like there's really only like Ethereum is really the only chain, and more so now Binance Smart Chain, that's having like any type of like, really thorough financial activity. Like the others are like, it's there because like it all just kind of, like doing forks is a really good way to like use the progress that's been made till then and then implement new things. So there is a lot of like fork, to work off of. But like the whole orchestration of the network is a challenge, because you're no longer relying on just like the Ethereum proof of work just to kind of work. There's a new force at play with whomever the hex-pulse or whomever the pulse validators are, and so there's different risk profile there, and so that's how all these things are going to come into play when people are trying to measure the how much they're what percent they want to hold in their in hex-pulse, and what percent you're going to want to hold in your hex ERC20, and so these are going to be really, really important decisions to make.
Structure or the
so
mining
let's finish up this question, and then we'll touch on some of the other things that you talked about.
I don't think you're going to run into problems. Like, for instance, the Pulse Chain fork, we're forking a known, wonderfully operating node, so it's based on Geth, and Geth is what everyone is, like, so that's the reason I'm looking for Golang developers. If you're a Golang developer, please reach out, t.me/Richard Hart or dev@hex.com. I'd love to see your resume. Could use a couple more guys. Yeah. There's just no examples for failure. It's really actually hard to fuck up. Like, even Dogecoin. Is anybody losing money on Dogecoin? Not really. Not from the network
Richard
side.
Hart
Some of the nodes are falling
Dogecoin
over, but still nobody's losing money on the network side.
Did OA buy Dogecoin?
This stuff works so well and has been around so long now that if you have a competent developer team, it's actually pretty hard to fuck up. Does that make sense?
What about outside of security? Like, just not being close to like other network effects?
Oh, you're close to all the network effects because there's bridges. So you're going to have liquidity bridges that allow you to off-ramp to ETH. So you'll have a bridge that swaps whatever the native token is on Pulse Chain over to Ethereum. And so you'll have a way to get in between those networks. And that, by the way, is how Matic works and how XDAI works. And if you go into MetaMask, it's really this easy. It works like MPSC. And you go into MetaMask, you just click your network, type a new network, click OK, and now it's a whole new world. You're on a fork of Ethereum. You change one setting in your network, which is up at the top of your MetaMask install. And then now they've got a button. So if you click a button, it'll bring up a window. And it's like, would you like to switch to this network? And it's already pre-filled out. It's really easy. And the MetaMask guys, they've always been happy to support multiple networks. So you don't have to worry about gatekeeping from their end, particularly since they make all their money on swaps now. So as long as they're making all their money on swaps, I'm very sure they'll be happy to support any network that they have the chance to make money on swaps from. I mean, I saw Hex can do a swap on just from using the MetaMask aggregator. The swap feature in MetaMask takes a 0.8% fee. Some guy just swapped using MetaMask, paid MetaMask $1,000 for swapping hex to USDC. Just gave away $1 grand to MetaMask. Could have used match.xyz, could have used 1inch.exchange, which I think is now called 1inch.io. Just gave away the $1 grand. Okay, all right. You know, you can look up their lifetime earnings. Like, they take all their earnings into a specific address for the MetaMask swap, so you can really see how much they're making. It is a lot. Good questions, man. I'm gonna take the next
Cool,
guy.
yeah, thanks, man.
So, you know, he's what he's talking about there is just kind of like, you know, there's liquidity bridges, and all of the wallets are like, you know, they'll support them if there's money going through. And so long as there's a market for those bridges, then it could just be like an instant, you know, bridge right there. So maybe that's opportunity to make some type of like, you know, just like make a like just a market for Hex. Like maybe that's going to be a really profitable further way to monetize your Hex that's not in a permanent stake, is to somehow provide your liquid Hex into the hex-pulse liquidity bridge. And, you know, so then you're, you know, earning yield by providing liquidity in something that, you know, if there's massive swing in the, you know, in the price, like, you know, one of the liquidity pool sides is going to be, you know, losing out. So, you know, that's the, like, there's going to be opportunity for earning yield in that way, which, you know, maybe with Uniswap v3, there can, you know, we can glean some of the things from that, where there's the, you know, where you're providing liquidity at like different levels, where it's not just like a constant like bridge, but if it's like the Uniswap v3, I'm just kind of spitballing here, but if we have like the Uniswap v3, you know, like, let's see if they have the picture, like these types, like concentrate your liquidity, like, you know, if we literally we should fork Uniswap v3 and you know, do these types of you know, like liquidity pools where you can set your bonding curve, and that can solve that issue. And then if, you know, that could be another way to just like, you know, at times of the year when the Hex on ETH is really in demand relative to the Hex on Pulse, you know, you shift where you're providing liquidity, or you stop providing liquidity. You know, or, you know, but then when it gets overpriced in the other direction, you'll like switch, and you'll be kind of, you know, that person who's providing liquidity. And, you know, where with the long-term Hex stake, you know, where you're locked in for 15 years, you're paying opportunity cost because you can't sell during that 15 years. But in Hex and Hex Pulse, you know, if you can, if there's ways to monetize that liquidity bridge, where you're not bearing the opportunity cost of, you know, in the like of, you know, being locked, but you're still able to earn yield. I think that could be a really powerful force for bootstrapping, like in all, you know, in additional layer of the network is, you know, is by just like, you know, creating that incentive where if you're not going to stake for, you know, if you're not going to do staking because, you know, for the long-term, you know, yield, like, you know, you want to keep some liquid, so you're not paying the opportunity cost of being able to sell into a pump. You know, you could keep it in this liquidity bridge, and whenever you need to exit, you can set where you're providing liquidity, so you're not just like, you know, buying the top or selling the bottom. Like, you know, you can balance where you do that through these Uniswap, you know, like concentrated liquidity pools. So I think that there, you know, there is a lot of opportunity to, you know, to kind of do this where, and then, you know, because if the, you know, it just like becomes like, even though there's value in having the like Hex, the Hex ERC20 stake as like an Ethereum based financial product, where maybe it does just converge to like, you know, $1 million or million Hex stakes minimum, 15-year stake, you know, minimum. Like you pretty much just have like anything under that, like maybe the gas fee is just never going to be economical. Like what if they increase it by even more? And so, you know, there's, you know, that one could become like the like ultra scarce like type of Hex that's not really used for a like, daily transaction and, but is like heavily financialized where, in a trustless way. And maybe that's the opportunity for like the hex-pulse fork, is to be like kind of a bridge to somewhere that can financialize these stakes, and that could, I think, make Hex a serious competitor for like a global reserve asset, like in between the years of 5,555 days from December November 19th, like that whole period of time, could be kind of where this, is cultivated. And, maybe, in that many, like kind of these, 5-year cycles, maybe maybe in that setting, like a hex, supported by like a hex that is financialized through a like kind of like hex focused but not hex exclusive blockchain. I think that can really lead to the just like the vast financialization of hex as an asset. And I think that's what can really boost the value of these Genesis T shares that are earning interest at an increased rate from any other staker ever. And then but anything pretty much beyond that, may need to be financialized to be able to reach a whole other type of user. And so I think that there's always going to be big value on the hex stake, because who's going to sell the price down? Because there's people that are like below the threshold of like what the minimum stake is. And I think that we can even like look at this break even. See if this. So like, how on the site we have the like that line that shows who's paying inflation and who's receiving inflation. Let's pull that up here. Because this is like the gas issue plays right into this. Like this really kind of like it moves up the line, because like per hex, like now you're earning the inflation, but you're paying the gas to be able to earn the inflation. And so, why is this? That's weird. The background color changed. Okay, I'll have to fix that. But this is like if you have 200 million hex, you need at least 3,536 T shares in order to break even with the inflation. So, like now we have to factor in this, like it's going to move this line up where now you have to, like, in addition to outperforming inflation, or like part of what's slowing you down from outperforming inflation is just like the new ETH coming in that you're going to have to pay in order to, capitalize on earning that inflation. And so what it does, it moves this line up. So it increases, so like if you have smaller amounts, you have to stake for longer to be able to use that longer pays better, to be able to counteract the increasing, stake cost. And you have to be using bigger pays better too. And so if that's like the new market reality where, we don't know, like, dude, Vitalik could increase the gas like by another 10x, like literally he could, absolutely. And like, if you're not the one writing the code and you're not the one that like, the financial network is, relying on to ship the code and like the financial network is going to accept the code, like, you really don't have any place in that discussion, and they really don't owe you anything. Like you shouldn't have expectations of Vitalik's work. Like, he doesn't owe you anything. And so that gas cost, what if in that reality, like that gas cost continues to increase? What it like all the people that are really, what that does, it's going to just increase this. And so, there's, going to be like a big like squeeze on the circulating supply, because stakes that, might have became unstaked are now not. So those people can't sell. Like those people that have their hex stakes permanently staked and all they have is hex-pulse, they're like, they can only buy the hex with their hex-pulse. Like they can't sell their hex for the hex-pulse because they couldn't ever unlock their hex. But the people that can afford it, the people that are way above this line, those people are going to have the option. So there's like a two-way street there. And so I think that's a big advantage that Hex is going to have over hex-pulse in the pricing, is that the hex to hex-pulse, for people that can afford to end their stakes, that's a two-way street. And so now all that those people have to do is factor in, the new reality that, there's going to be there's going to be a curve where, there's going to be like a curve of like optimal stake length or like per stake size, that's, that the market's just going to converge to, because